Greetings, everyone, and welcome to a new podcast show by Eric Dubin and me, Dave Kranzler, called WTF, What Just Happened, ? And it's going to be a podcast that we review current events and ask the question, what the F just happened? It'll for sure be ad-free and hopefully inject some humor into it.
And hopefully not get censored by YouTube.
Yeah, that's key. We're hopefully fall underneath YouTube censorship boundaries. It's certainly taken down a lot of hits on a lot of truth-seeking websites and podcast shows.
And you and I have been blackballed by the Washington Post for the prop or not list that was involved with the 2016 presidential campaign propaganda by the deep state to try to label alternative news sources as fake news. They blackballed Ron Paul, former congressman. They painted the Zero Hedge website as a purveyor of fake news. They attacked Dave's site, investmentresearchdynamics.com. They named the site The News Doctors, which at the time I was serving as the managing editor. They named Silver Doctors. They went after all kinds of people in an effort to try to blame the outcome of the U.S. presidential election on nothing but propaganda associated with interests associated with Russia. That entire intelligence and propaganda meme totally fell apart, and now we don't hear a lot about it precisely because there was nothing there to be spoken of. We'll try to cut through all of the propaganda fog and give our audience some perspective on markets and politics and help people make some good money.
Likewise, Eric. Good to be with you as well on this show. So I guess we should just get right to it. The Dow was up over 400 points again today, and the trigger cause, or at least the cover story for it, was supposedly a speech given by Chinese Premier Xi Jinping last night at what's considered the Asian Davos, where he offered to be receptive to opening up China's borders more to foreign trade, and apparently the hedge fund algos misread it as saying, oh, the trade war with the U.S. is over. So it was party time starting late last night when the S&P futures jumped about 30 points in response to that speech. Well, as it turns out, he didn't say anything different than from a speech that he gave in Davos, the Western Davos in January. And for me, I look at it as just another bear market, short covering rally. The volumes today were extremely low relative to the past several weeks, and the extreme intraday volatility in the markets, which we've seen over the last couple of weeks, continues.
We have seen a shift, and let's talk about that, Dave. January, we launched into, if one looks at a 5-year chart of the S&P 500, one can literally see the last period from January 1st onward till about like January 26th, and after, the Davos meeting and the secretary speaking about how it would be in favor of a weaker dollar and how that, in fact, has been pressuring the treasury market and yields rising, and all of the things that have come that have shifted perspective in the markets. We saw a really big correction as well, too. People are no longer assuming that we live in a world where there's no more volatility. The markets have completely changed in their character. We had years of an upside bias and people operating on basically autopilot. Things are different.
It's funny because in my February 11th short sellers journal, I went back to look at it because I was trying to look around to see if there was any specific news that might have triggered the stock market sell-off, and there's nothing really specific that caused it. It wasn't like a drone missile hit the S&P 500 and the S&P 500 began to collapse. And the title in my February 11th short seller journal issue is "Insane Valuations on Top of Insane Leverage," and the market had run up. As you pointed out, the last month of the run-up, the S&P was going up at almost a 60-degree angle, and it's the sharpest angle that you and I we reviewed what the graph of the S&P going back to the dot-com bubble and the collapse, and it was a sharper run-up than we saw in 1999, early 2000, and a sharper run-up than we saw in 2006 into mid-2007. I think we just essentially got to a point where the market finally decided to recognize the fact that the market was historically the most overvalued in history. And I don't care what numbers you want to use. If you adjust the reported GAAP earnings so that 2018 GAAP is the same as 1999 GAAP, the PE ratios in 2018 are going to be higher than they were in 1999. So I think the cover story being, the trade war, tensions with Russia, I think that's all they are, is just essentially cover stories for the fact that the market was just insanely overvalued. If anything, the 10-year yield started ticking up towards 3% by the end of January, and I think that probably played as big a factor as anything in toppling the market over.
It's the most important factor, frankly. I mean, the price of credit and how that spills into absolutely everything else. We have a market, all equity markets have been flying on excessive credit, and excessive credit has been the story since 2009. And we had the biggest bubble in the bond market in world history. And through 2017 to the end of last year, we pretty much never exceeded 2.6 yield on the 10-year, other than, like a couple of days here and there. We were in a relatively tight range. All of a sudden, come the turn of this year, we launch out of 2.4% and go testing 3%. And the majority of that move was in January, and that's when we peaked out and sentiment shifted. And when you look at something like a universe of the S&P 500, that's when the markets had peaked out. And I think we have already seen the top with the equity market, and we'll just continue to churn and roll over and go into the next correction that leads into a giant bear market. And all of that starts this year. We're in it. It's a process, not a singular event.
I would agree with that. And I also just wanted to throw in there, I had a graphic of a table that I had found that had several different measures of investor sentiment, retail and institutional. And every one of those sentiment indicators were in the 96th percentile of extreme bullishness or higher. Most of them were in the 99th percentile. So again, that's just more anecdotal evidence that, by the end of January this year, the market had reached its most extreme overvalued level in several different respects.
And, Dave, when we think about how markets work and how price discovery happens in markets and just how people go through big cycles of complacency in the Wall Street community and they adopt what they believe is the right strategy for the current market paradigm, and the vast majority of market participants go to sleep. They just operate on the assumption that what they have been doing has been working, and they don't really muck up their strategies until markets turn around and whack them in the face. And that's kind of what has been going on in this year. A lot of new volatility has entered into the picture, and assumptions that money managers and home office managers for the ultra wealthy, and there's enough money out there where people managing their assets are looking around and seeing that we've been in this multi-year aberration of an economic expansion that's been largely artificial, markets supported by gigantic liquidity, and all of a sudden things have changed. People are no longer assuming that, or at least a sufficient number of people are no longer assuming that the Fed and other central bankers are always going to have the punch bowl at the ready to save markets. In these last 4 months, we're seeing very different trading patterns in the way the market has been versus how it's been since certainly 2012. I think that's really the take-home message. Interest rates will continue to rise in general. Do you agree with that, Dave? And how do you see that as being the catalyst?
Oh, absolutely. I mean, if you look at just mortgage rates, mortgage rates they're probably up about 80 basis points from their recent bottom last year. They kind of bottomed out around 370, 380, and now they're around 450, 4.5%. And just on, so we're talking about less than a 1% rise in the cost of taking out a conventional mortgage. Refinancing activities have crashed. And that's just the effect of that 80 basis point rise in mortgage rates has wiped out any kind of savings incentive from refinancing your mortgage. But it's also affecting home sales quite a bit when you actually bore down into the numbers and look at what's really going on, not the monthly, the seasonally adjusted monthly number that's then converted into an annualized rate that both the National Association of Realtors and the Census Bureau, which does the new home sales report, churn out. Home sales are taking a big dive. And again, just like they're using the trade war as a cover story for the market volatility, the housing industry is using low inventory as a cover story for why home sales are sagging. And they're sagging because just an 80 basis point rise in mortgages takes a lot of potential buyers out at the margin in terms of being able to support the monthly cost of home ownership. So imagine what's going to happen if we have another 1% rise in mortgage rates. I mean, you're going to have an absolute housing collapse. And there's a lot of ways to refute the low inventory argument, but one easy one is just look at Manhattan. Manhattan real estate transactions were down 25% in the first quarter this year. And believe me, Manhattan has plenty of inventory. New and rental inventory, new inventory, existing inventory for resale, plus rental inventory, and it is absolutely crashing. And one of my subscribers works at a fund that does, one of the things they do is hard money lending to real estate flippers in New York, and he told me that he was talking to one of the investors that they work with who is now pulling out of the market, and my subscriber's comment was, if this guy's starting to pull out of the market, it means things are getting really bad in New York.
There's been so much credit leverage throughout everything that when you have the price of credit being as low as it was artificially, everything gets distorted. And we're
valuations on top of an insane amount of leverage.
Yeah, exactly.
WTF.
Yeah. Indeed. And now, because of where we are economically and because of the frictions that we're having with, the block of countries that are associating themselves around Russia and China and how that is a competition to an American-led empire, we're looking at an economic downturn, a stock market that is primed for outright crash, assets that are overvalued, and surprise, surprise, they're beating the drums of war. Could it not be a better recipe for a WTF kind of scenario? I mean, it's quite scary. Last year, around this time, Trump lobbed 50-plus some odd Tomahawk missiles into Syria, in part because he was feeling quite a bit of political pressure. I mean, Trump's administration has been under attack pretty much 24/7 ever since he came into office, but now and then the political pressure that he faces gets amplified, and we see the possibility of us having stepped up confrontation in Syria right now. The echo from last year is quite telling. The FBI is investigating Trump's personal attorney and piercing the attorney-client privilege, and Trump is feeling pressurized. And the last time that Trump lobbed the cruise missiles into Syria, he was even getting praise from people like Hillary Clinton and Lindsey Graham, warmonger politicians. So the tendency for politicians to wag the dog when we have economic and political turmoil like we do now rises. And this is going to be a backdrop throughout the rest of this year as well. We're going to see a lot more geopolitical turmoil expressed on the world stage, because China and Russia are in a position now of being able to flex their muscles vis-a-vis the United States.
That's right. I agree with everything you just said. And to me, essentially the old, the economy's failing, we can't fix it. When all else fails, go to war.
Yeah. And ongoing bread and circuses as the left and the right scream at each other in the United States, and nobody has an understanding of anything.
That's right. Throughout history, it's kind of the last gasp of a collapsing empire is to lash out militarily against your enemies, real or imagined.
There have been 3 previous gassing events in Syria that were attributed to President Assad gassing his own people. 2 of these were clearly false flag operations that were executed by the so-called rebels that the Americans and other allies have been supporting. We recently saw an event this weekend. It's unclear exactly what happened, but over time, truth will come out. But the pattern is such that it's very likely that this is probably a false flag operation, and it's certainly being used in a propagandistic way. Once again, people in the West are being told that we must come to the aid of oppressed people who are being butchered by a new Hitler. And that way of, trying to bring support for efforts of war is kind of like an off-the-shelf policy solution that the establishment reaches for so many times I can't even count.
Well, hey, if it's a headline on CNN or in the New York Times, isn't that hard evidence?
Yeah.
Isn't that just enough evidence?
Sources say, quote unquote.
By the way, is propagandistic, is that actually a word?
You're the English major.
Did you just make that up?
When we have all this volatility in the markets and this backdrop of geopolitical concern and domestic politics being just about as bat guano crazy as possible, that's a pretty interesting scenario with gold.
Bat guano, does that mean bat shit? It's been well reported that the hedge funds are net short silver. They have been for the last 3 weeks, getting more net short silver, and in 4 out of the last 6 weeks. And they've never been net short silver, at least going back to 2004, which is the data that I have on a weekly basis from the COT reports. And certainly that's been well advertised, and it's an extraordinarily bullish, I should say, backdrop for a massive rally in the price of silver. However, there's a wet blanket that's thrown on top of that right now, and that's the gold, the way that gold traders are structured right now. So you still have an excessively long, net long position with the hedge funds and a very large net short position with the banks. And this is just my opinion. I don't think that the wet blanket on top of silver will be removed until the commitment of traders, the structure of it changes so that you have more of, the hedge funds a little more neutral and the banks a little bit more neutral. At least that's how it's played out, in cycles over the last several years. However, it seems like right now they're having trouble getting gold to have one more sort of washout that'll trigger hedge fund selling and enable the banks to profitably cover their short positions. And I do think it could be, this backdrop of trade tensions, geopolitical tensions, and essentially deteriorating economic conditions, not just in the U.S., but globally. I think a lot of people have finally thrown in the towel on this idea that there's a quote-unquote globally synchronized economic recovery going on, because we're starting to see bad economic numbers from a lot of countries, not just the U.S. So what I will say is that I have been for the last few months expecting one large washout, abrupt, short and sweet. It wouldn't take gold below 1,300, but it would neutralize or sterilize the way the traders are set up on the COMEX. If we don't get that, and if gold keeps going higher, 1360 in my opinion is not just mine. I think it's kind of commonly discussed number out there as the point of resistance right now. That's, if gold can get above that, we should see 1,400 pretty quickly. And if those two events were to occur, I think you have the potential here to get an upside melt up in silver, just because of the way the various trading cohorts are set up on the COMEX. And
leaning on silver silver is considered the kryptonite of the precious metals suppression operation. But I think the take-home message that you and I have talked a bit about before we hit the record today is that there's been underlying support, and that the cartel has not been able to suppress gold and silver all that much. I mean, if they had their way, silver would be in the $13 handle and gold would be in the 12s already. And they haven't been able to do that because of the, underlying fundamentals being as strong as they are, even with interest rates on the rise. People need to understand that interest rates going up is not necessarily something that is always a bad thing for gold. Historically, we've seen some of the biggest moves in gold with interest rates moving up.
Yes. The reasoning for that is by the time the Fed starts raising rates, the market just assumes they're already way behind the inflation curve.
Right.
In terms of the underlying physical market support for gold, there's been a condition of backwardation in London for quite a while now. And that's always an indication that there's strong physical demand for gold that they're having trouble satisfying deliveries for. And this is with India has been kind of quiet the last several weeks. China's now starting to go back into buy mode after being down for a week for holiday observance. We don't really know what's going on in terms of their doré imports, in terms of the volume of it or the smuggling, but the official imports have kind of slowed down, and part of that is because of gold's recent price rise. But we'll soon be heading into another very strong seasonal buying period for India, and the longer this kind of sideways trading in gold persists without the commitment of traders kind of cleansing itself, the more conducive it will be to an upside explosion, later this summer and into the fall. So there have been, I can think of off the top of my head, and I'd have to look at the data to get an exact time period, but there have been one or two times when the commitment of traders was structured like this, with the hedge funds long and the banks short, and gold just continued higher. I want to say it might have been in 2008 or maybe 2009. But I'll get back to you on that.
So this is our inaugural show, and we're going to try to do 20 minutes, some odd reportings as to what the F is going on in our markets, and looking forward and analyzing what probably can come to your wallet. Dave and I have upwards of nearly 60 years experience together, looking at markets from different perspectives. We're looking forward to building this show and bringing ideas to people and interacting with our audience, and we got a lot of great surprises for you coming up. It's currently being sponsored by Wall Street for Main Street, and we're happy that Jason Barak and all of the wonderful people in his audience can check out what we're doing, and we're looking forward to helping Jason and Wall Street for Main Street grow, as well as introduce people to the work that Dave and I do. Be sure to check out Dave's work at investmentresearchdynamics.com. You can find what I am up to and soon to be publishing a lot more by just checking out what I'm doing over on my Facebook page. Easy to find, facebook.com/Eric Dubin. And Wall Street for Main Street is also on YouTube, as you see here. Subscribe to the channel and help build Jason's great property.